Good day, fellow investors. Welcome to the stock market news with a long-term fundamental twist. And before we start discussing all the economics issues, stimulus, inflation, deficits, growth, productivity, and all that matters when it comes to an economic perspective, let me give you a mindset perspective. Just 10 months ago, this was the most sought after asset to store at home. This was the most valuable thing. While now already we are thinking about completely other things, from bitcoins, from stimulus cashes coming in for free, thousands and thousands over the year. So the main point is that things always change, and economics is a behavioral discipline because it's made of people. How we behave impacts the numbers we are going to discuss today. We're going to start with the current topics, the economic situation, and then go into the outlook, and then conclude with an investing overview of how these things can impact our investment strategies and positions. Again, on mindset, what is the current environment focused on? Are they focused on economic fundamentals or stimulus plans? Will the stimulus plan be 1.9 trillion or 2.5 or 1.6? What will pass? What won't pass? Trump getting out of the White House? How is he going to get out? And all those things that put really important matters into a second degree, as is unemployment. What's going on with politics? Okay, here something mentioned about unemployment, but okay, small, and this will likely tomorrow be forgotten already. We have a new stimulus plan that includes 2,000 stimulus, paid leave, state aid, unemployment insurance, minimum wage, paid leave, childcare, rental assistance. My fellow American investors, welcome to Europe. Benvenuti, willkommen. And despite the stimulus that's there to help something that's very bad, if not, you wouldn't need stimulus, the stock market just keeps going up and up and up. And if we look from the bottom in March, the stock market is up 70%. That's insane for the economic situation that we are having. 70%. If we go further back, we see how the market is up 100% in 5 years. 100% the stock market up. Is it because of fundamentals? That's something we'll discuss tomorrow when we analyze the fundamentals of the market and what is in a bubble or not. So please click that like button and subscribe if you get value from these videos, if you enjoy them, so that you get notified when others come too. And a good overview of what's going on is BlackRock's earnings. So they manage all the ETFs, index funds, and looking at their earnings tells you also about what's going on in the market. If we look at flows, retail investors were a bit shy earlier, and now that they are home in lockdowns, they exploded. Everybody wants to invest into stocks now, plus iShares, ETFs, really positive inflows as the stock market keeps going up, so that must be the best place to put your money in. But there are issues with the current environment that are not reflected in the stock market, and there is a discrepancy in divergence that's important to keep in mind. Trouble, unemployment is increasing. What's the solution? Stimulus. Let's just give everybody money, everybody happy, right? Panem et circenses, would they say in ancient Rome. However, if we compare the current crisis with the 2009 crisis, unemployment, I'm using US data, but it's similar in Europe and around the world, it's much, much worse than it was in 2009. That's something to keep in mind and think about. What if there is a market crash? Well, if we see stocks crash, we're going to print money and put rates to zero so that we prevent any kind of crashes, because the financial system cannot survive these crashes. What about budget deficits? Aren't those a concern? If they give stimulus, it has to come from somewhere. Oh no, that's going to be solved with inflation or more Fed money printing. No worries. But the real situation, the real economic situation is that most of the world is in lockdown. So there is no traveling, there is no spending on a lot of things. Everything is supported by stimulus, by government help, by loans, and that's something not sustainable. And this leads into the introduction on what is the economic situation now and what's likely the outlook. Just printing money, I think we all understand it's not sustainable, and that's something to start to think about now, because we are long-term investors. This is from Deloitte, the economic assumptions. So everyone thinks, if we look at the trend over time, that it's going to be an interruption and then boom, all growth is just going to continue. Base case, even just continuing on there where it was. Worst case scenario, we have a long slog and only recovering by 2027, 2026 to where it was before. But these are estimations, and estimations are always exuberant. Everybody has clients, you need to keep them positive to spend their money with you. But it's insane that the economy just keeps on growing forever at the estimated rate. There will be these interruptions, shorter term and longer term, and that's something that we have to accept as a given. Let's take a look at industrial production. Over the last, 13 years, the index now is 104 points, and in 2007 it was 104 points. American industrial production went nowhere over 13 years. Stimulus, lower interest rates, stock market went up more than twice since then. But industrial production, real productivity went nowhere. And that's something to keep in mind when you are thinking about, okay, long term, what are the fundamentals of the economy? Also in Europe, the estimations are that everything will be good, everything will be great, but we still haven't seen the new estimations because the whole of Europe is in total lockdown, and the lockdown is prolonged till March, till April. Nobody knows when will this end. Hopefully by April, May it will end, but that's already a complete year in half or more lockdowns that's going to have severe consequences on the economy, on budgets, and everything that's real, not printed nominal growth or inflation or whatever. If we look at unemployment rates, those are stable in Europe because they have a different system. They are paying people to stay home, so they are not registered as unemployed. But the US is the real situation, and now it's picking up again, and this is the same also in Europe and around the world. Good to keep in mind. So let's discuss inflation, deficits, debts, the real economy, and how will this affect us over the long term, not just the next 3-6 months, because long term is what matters. Everybody's so focused on the short term and on how big the stimulus will be, and that's what's driving everything. That's insane. So here we are for the long-term perspective, which is key after all. If we look at unemployment, jobless benefits, it was very, very low before the crisis, exploded, but still very high, and now again picking up. In Europe, the situation must be even worse because we have had lockdowns for the last 3-4 months. Lockdowns, no work, leads to a lot of budget deficits, something that has worried economists over the last decades. Now, nobody's worried about. Eurozone budget deficits rise almost tenfold to counter pandemic. Similarly, in the United States, net debt budget deficits 15.2% expected in 2020. 2021 expected borrowing of another almost 2 trillion, and we don't know whether it will be more or less. So GDP, debt to GDP ratio skyrocketing, and if we look at the debt line, the US debt line, we see it exploding from 21 billion just up and up to the current 27 trillion and even higher. That's really, really insane to look at, and nobody cares for now. It's easy to get in debt. All you need is low interest rates, and the Fed is projecting to keep interest rates at 0 for longer, this is the next 3 years, and then somewhere down the road, somewhere in the future, increase it to a stable rate of 2.5, which is what should be the long-term balance. And they have been saying the same thing for the last decade. They tried to increase rates a little bit in 2016-17, but it soon was clear that it's impossible to have rates even in 2%. So even before the crisis, rates started going down, and now they have bottomed again, and we are back to this scenario. With interest rates at zero, it's easy to borrow. Everybody is happy. Free money is what's out there. But if you look at the average interest rates for the US government, it's 2.5%. And if you look at federal government debt expenditures, those are around 600 billion, 506, now much lower because the interest rates went down. And if we look at the 5-year constant treasury rate, which is the average maturity for the government, 6 years, you see that interest rates are really low, but those have started to pick up a little bit. So those are more than twice what those were in July. So this is very important, because if the Fed is forced to increase interest rates, then it can get very, very ugly for the US government. Let me just explain. And for all other global governments. If we have total debt of 27 trillion, if we have payments of 600 billion, and if we have interest rates at 2.5%, and if those interest rates go to 5%, as it was the case normally in history, then the US government's interest payments go from 600 billion to 1.2 trillion. And if you put here another cost of 600 billion, that's just borrowing to pay for the debt. That's insane. That's called the Ponzi scheme. And that's the situation the governments are in. How are they going to get out of that situation? Well, the Fed has already promised higher inflation to help the government printing money, but what we are seeing is that people are running away from currencies and going into everything that is real fixed assets, bitcoins and whatever they are finding a way into. In the Netherlands, home prices in the worst year in the last 5-10 years have gone up 11.6%, and everybody's looking for a house. But keep in mind that just 7 years ago, 8 years ago, the US, Netherlands, when we were buying a house, we could see it 3 times over a month, 2 months, make an offer, think about it, etc. Now, everything goes like this. So keep in mind the perspective and the cycle of the economy. In the next 5-10 years, it's likely that we're going to see 2012, 2011 all over again. That's natural. So good times and bad times always come around. That's a given. But inflation is not reported in the statistics in the US also. It's very, very interesting how that works. But okay, we'll see how it goes. I don't expect things to be linear. I am ready for everything. And I'm ready for things that we might be discussing in the future or not. Whatever happens, you have to be okay. That's the key when it comes to investing. Plus, there are other things that might hit us economically. Where is the stimulus coming from? Printed money, which means that everything is, let's say, a house of cards and nobody's focused on productivity, education. What's going on in Asia? 5.5 billion people entering the middle class, competing. You are watching this from a guy in the European mountains, which is taking time from prime American television. So that's something very important to think about, how the world is getting global. And at some point, by doing unsustainable things, we from Europe and the US, we are actually eating up the fundamentals of the long-term position we have had. And that's something that's going on. It's obvious, it's bleeding obvious, but nobody cares because that's the ugly side of the situation. When it comes to the outlook, I know that there will be something bad coming in the next 5 to 10 years. We have already discussed real estate, we have seen the Greek crisis in 2012, the financial crisis in 2009, the COVID crisis now, and there will always be something that's coming up. Can we predict it? No. but we have to be ready and take it as a given. And we live in interesting times, and to give you a positive, I think it's very positive that over the last year the system didn't collapse. We always were able to buy the most important things. There was food, yes, the most important things, and so everything worked. Governments intervened, there was a flow, there was no liquidity crisis, so that's a big positive, and that's a big positive that might help us also long term, because that's also the nice things about humanity and economics. Everything is an evolution. Problem, solution, problem, solution, problem, solution. So we also have to accept that in the ups and downs of the cyclicality. But yes, currencies will be sacrificed, are sacrificed with all the printing deficits, so we might see higher taxes or inflation, which is again another tax, but you are not feeling it like a tax. So there will be things that will be different than now, and that's something that we have to again accept and be ready for. What will be next? I wish I had the answers, and anybody that's giving you the answers is just lying to you. There are no answers, but you can find some answers if you just go back to the basics. When you invest, okay, if I do this, how might this look in 10 years? Let's say I want to keep 100,000 on my bank account as safety, as a safety net. If I do that over 10 years, if the dollar loses, euro loses 50% of purchasing power, am I okay with that? Yes, no. And so you start structuring your portfolio. There are other options. Am I okay holding gold? Can go nowhere for 5 years, can go down, can go up. Am I okay with that? It is an opportunity cost, but then you have to see what best fits you. How flexible you are from a personal perspective. What is your job, your skills? Are you anti-fragile? And that's also something to think about and build over the long term. And my main message is, and what makes it easy for investors is this: you invest to accumulate wealth over time, and I cannot stress the importance of this. You invest to accumulate wealth over time. So let's say in 2020 you buy a home, stocks, start a business, whatever. 5 years down the road you buy more stocks, or then you buy a rental property, then you buy more stocks, then you sell them, start a business, from that you buy more stocks, and over the cycles, over the economic cycles that are inevitably ahead, you do well, you compound your way to a good financial stable life. That's the basics of investing, no matter what happens in the economics. I wish I knew. If you know what it will happen, please let me know in the comments below. What I know, that the world will be a totally different place in 15 years, as it was a totally different place 15 years ago. Just look at interest rates. 15 years ago, interest rates for the 5-year treasury, you could buy a bond at 4.6%. 30 years ago, you could buy one at 6%. 40 years ago at 15%. Over 5 years. This is how the world changes, and we don't know whether this will be at 0 or at 5 or at 8, 10, 15 years down the road. This is something we have to accept and be ready for. As the prophecy was, 7 good years, 7 bad years. We don't know when will those happen, but if we accumulate wealth, if we are conservative, if we invest, if we compound, then we'll do well. That's the best message I can give you. And the same with Peter Lynch. The way you lose money in the stock market is to start off with an economic picture. I also spend 15 minutes a year on where the stock market is going, and if you spend more than 13 minutes analyzing economic and market forecasts, you wasted 10 minutes. Nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. The GDP 6 months out is just malarkey. How is the sneaker industry doing? That's real economics. And with that terrible disappointment on economics, I'm going to leave you today. I'll see you tomorrow discussing the fundamentals of the market, Sunday stock analysis, and Monday also boring good stocks analysis. Thank you for watching, click like, and I'll see you in the next video.